Well, this week we wrap up the first half of '05. So with sky-high oil prices and concerns over inflation, interest rates, earnings, and more, investors seem to be split on what to expect for the rest of the year, both here in the United States and abroad. Well, with his take on the markets and the economy is Peter Schiff. Mr. Schiff is president of Euro-Pacific Capital, which has just relocated to Darien. First, welcome.
Thank you. It's nice to be here. Beautiful day today.
Yeah, it's gorgeous. And I think we should say that I think it's safe to say you're a bear. Is that not correct?
Yeah, I'm a grizzly bear.
You are a grizzly bear. They call you Dr. Doom.
Well, CNBC calls me Dr. Doom. I told them to call me Dr. Reality.
All right. Well, first of all, what are your thoughts on the second half of '05? What do you see?
Well, I think the U.S. economy is basically a bubble. I think we don't have a viable economy in that we don't produce, we consume, we don't save, we borrow, and right now the rest of the world is financing that extravagance. And I think it's going to come to an end. Whether it happens in the second half of this year, we don't know. But I can tell you some things that are happening right now, look very ominous. We have a huge move up in the price of gold, not only against the dollar, but against the other currencies of the world, particularly the euro and the Japanese yen. This is the first time in years we've had a real gold rally. Today, again, oil is up another $1.50 a barrel. We're at $60 a barrel, and I think we're going a lot higher than that. All commodities are moving up, not only against the dollar, but again against the euro and the Japanese yen. And I think this could be a sign that things could get a lot worse, because I think that the European Central Bank might be forced into a surprise rate hike based on commodity pressures or inflationary pressures building up in the Eurozone now as a result of the weakness in the euro. And I think that could really send the financial markets into a tailspin, because nobody expects that. And if interest rates start to go up in Europe, that'll push the euro higher against the dollar, and that could put a lot of pressure on our bond market. And we need low interest rates right now in the United States to support our housing bubble, to support the stock market bubble. So when interest rates start to rise and these bubbles start to unravel, we can see a lot of trouble in the second half of the year.
Which puts if this scenario is accurate and is going to happen, this really puts the Fed in a very difficult position when it meets this week, for example, what to do with interest rates.
Well, the problem is the Fed has to keep raising interest rates. They're already much too low. And despite all the propaganda that people hear on, typical financial broadcasts about how inflation is contained, this year the CPI is running at its fastest annual rate of increase in 15 years. And that's even with the distorted way the government now calculates it. So I think there's a lot of inflationary pressures building in the United States. In fact, I think the second half of the year for CPI is likely to be worse than the first half. And if we get the CPI up to about 4.7% for the year, right now it's running at about 3.6, 3.7, but if it gets to 4.7, that will be the second highest annual rate of inflation in 25 years. So if people think there's no inflation, inflation is pretty rapid. I mean, in 1971, when Nixon imposed wage and price controls, the inflation rate as measured by the CPI was only 4.1%. So back in 1971, we thought 4% inflation was so bad that we imposed draconian measures, and they were misguided, but obviously we thought it was a big problem. Inflation is probably going to be worse this year than it was in 1971. So the Fed is way behind the inflation curve. They've got to raise interest rates substantially. But the problem is they know that the U.S. economy can't withstand it, that people with their interest-only and their adjustable rate mortgages are not going to be able to make their payments if the Fed put interest rates up to where they needed to be. And if real estate prices collapse, our whole economy is based on homeowners borrowing money against their house and buying imported products.
So what is this going to mean for the stock markets for the second half of the year?
Well, stock markets are going to come under a lot of pressure. I mean, we're still in a bear market in stocks. I mean, we were in a bull market in U.S. stocks from 1982 to 2000. Since 2000, we've been in a bear market. And stocks are going a lot lower. The lows that we put in the stock market in 2002, they're not the lows of this bear market. We're going a lot lower. So if you remember, the NASDAQ was down around 1,100 in 2002. We're now close to around 2,000. We're going to go a lot lower than 1,100. I still think we're going to about 500 on the NASDAQ. The Dow Jones is not going to be quite as weak, but it's going to lose a lot of value. And what's going to hurt stocks are going to be falling corporate earnings and rising interest rates. Because the way you value a company is you take the present value of its future earnings and you discount it to the present based on interest rates. So when interest rates move up, by definition, stocks are worth less. But also what's going to happen is when interest rates rise and this economy goes into a recession, corporate earnings are going to come under a lot of pressure. So at the same time corporations' earnings are falling, the interest rates that you use to discount those earnings are going to be going up. So the values of corporate stocks are going to drop sharply. Plus, a lot of companies are going to have problems with their pension obligations. And a lot of companies, of course, have a lot of debt. A lot of U.S. companies have short-term debt. And when interest rates go up, it costs them more to service their debt, and that directly hits their earnings.
Well, I think I have to call you Dr. Doom too, Peter. Thank you so much for joining us.
Well, thanks for having me.
All right. Well, that's all for this week. See you next week on 12 on the Money. I'm Rebecca Saran.